Okay, welcome back everyone. What we're going to be doing in this video is talking about adverse selection in the context of market making. So if we go straight to the board here, so we've got this concept called adverse selection, and this is something you do, like something you got to really look out for when you're market making here, right? Now, what is it? So essentially, it's when you get a fill that you don't want to have. So let's just go for a concrete example here. Let's just use this. We're trading, let's say for example, we're trading BTC USDT, and this is what the order book looks like here. So we've got the order book, and maybe we've got the best bid here. That can be the best bid. Let's just call it bid one, and we've got the best ask here, right? Cool. So that, and actually here, let's actually put some concrete numbers to it. So the bid could be we'll just say 60, yeah, we'll go with 60,000. And then the ask could be, you know, 60,010, I believe. Now, obviously, the price of Bitcoin is like 100K at the moment, so you know, this example could be a little bit dated. But what's going on? So when you're market making, what you really want to look out for, right, is if the market moves and you're way too slow to cancel your orders and then put them in a more appropriate place. So what actually goes on is we've got this fair price F, and then how it works is we put some spread around the fair price here, right? We put some spread around the fair price here. Now, what happens? Okay, actually, first, let me discuss how we get this fair price here. So maybe we could be market making on a less liquid exchange, like I don't know, let's just call this like exchange 1 or something like that. Yeah, let's call it exchange 1. And now, how do we get this fair price? So the fair price could come from oh, let me just do that. It could come from Binance. It could come from Binance. Binance. My bad. Bad at spelling. It's okay. Binance could come from Bybit, and it could come from OKX. Now, why did I choose these exchanges? Because they have, you know, they're the exchanges with the most volume here, right? The most volume. And so what one would do is you'd look at maybe the spots and the perps traded on these exchanges, and then you take some sort of average, right? And then that average would be the fair price here. That would be the fair price of BTC. And then what you do when you're market making, you put some spread around that, right? Now, one thing that could happen is say say Binance move. Now, yeah, Binance will move, right? It like say you've got this is Binance, and maybe the price of it it just moves up drastically, right? Now, a smart market maker would be like, okay, Binance is actually the lead exchange, and all the ones here and all the smaller chains will follow it. We call this the lead exchange. And then what you would do, you would update your price quickly. You would update your price. So you'd update the fair price and put that higher. And what you do, you'd end up canceling these asks here and move that up quickly. So you'd cancel and replace that. And so instead of getting picked off at this ask, you would cancel and go up there. So actually, let me just use this eraser tool here. Just make everything a little bit more cleaner, just a little bit clean. I'll clean it up. Actually, let me just erase this diagram here. Yep, just delete all that. That's okay. Oh, here we go. That's looking good, and we'll go back to the pen tool right there. So let me go back to that example, and we've got the brush tool. So what happens is, okay, we've got two situations. We're here. This is the ask. This is the bid. Price moves. Price moves up. right? So what you want to do is you want to, so here, now just imagine we're on the same line here. What you want to do immediately is cancel your ask and then move it slightly up. So you don't get picked off. So you don't get picked off here. So this one doesn't get picked off. And what happens is you'll get filled at a higher price, which is what you want, right? Which is what you want. Because what will happen is you get picked off here and you get filled there, and then you end up then the price just goes against you. So that is not what you wanted, right? So yeah, and we call those like the toxic fills, right? So more informed traders can just pick you off there, and then the price will continue to move. Now, solutions. How do we fix this? How exactly can we fix this? So speed. So the solution is being faster with speed. So let me make sure I'm on the right thing. Yep. So the solution is speed here. The speed helps. So what you want to do, yeah, essentially the solution is quite simple. Here's your ask, and here's your bid. And then here's your fair price. So let's say your fair price. Now, if you're faster than everyone, right, and say the fair price moves up, your program immediately detects that, and then what it will do is it will just sort of cancel this ask here. We call this and if it doesn't cancel, it's called a stale order. We don't want the ask to be stale. It'll cancel, and then it'll sort of open, and then open it again up here. So that's exactly what you want to be happening there. And then you will get a better price. Now I think let's put a bit of numbers in it. So it's like, so in crypto, right? Crypto is actually, because everything is over the internet, unless you actually co-locate your stuff on an exchange center, we're going to be talking in like tens of milliseconds, right? So like, 1 to 10 ms. We don't have to go into the microsecond game right here with crypto, because it's all over the internet. But if you do manage to co-locate your stuff, which is cool. So for example, there's the LD4 data center, which is next to a Future Exchange, or you've got the Binance Tokyo, right? You can house your algorithms there, but it's not, you're not particularly playing the HFT game most of the time if you're just going over the internet. So okay, I tell you what. So what I'm saying here is the best thing to do to get these speed games is, like, for retail people, realistically, to actually compete. So I'm in Australia, right? So this is, I don't know, Australia is at the bottom of the world, and then you've got so you want to fly over to London. Maybe you're trading on Deribit. I think their exchange center is in they're in London, where they host their things. So, and you've got Deribit here. Now, obviously we're all the way on a different side of the world, right? And so that's going to take time. That, honestly, I remember measuring this. It takes like maybe 1 to 2 seconds. That's nuts. But if you have an exchange, if you go on like AWS or Ali Cloud or something like that, and you get a server, EC2 instance or box or whatever, and you put it in London, that's gonna make you play the millisecond game, and then what you want to do is you want to measure it. So that's actually that's the first thing you need to do. So you need to get all this co-location stuff going, right? And then the second thing you want to do is, when you've maximized that, is then you can start looking at whatever trading HFT algorithm you're using and start shaving off microseconds from there. So that is that's the co-location game, and that is adverse selection. I just thought I wanted to chat about that for a little bit. Hopefully that was somewhat helpful, and I guess I will see you in the next one.